let's talk about one of the big ones that we've referenced. We're going to talk about implied volatility as a big part of extrinsic value. Implied volatility is an assumption that is made in which the option price is related to future expectation of movement. You can back out an implied volatility level based on the price of the option, because option price and its commensurate implied volatility level are linked as long as you have the same underlying price and strike price and time to expiration. You can use all of those things to back out an implied volatility level from price, and you can use it going the other way too. You can punch in an implied volatility level to a model and get an option price. And that's how option market makers really move the value of options in a very quick way. It's what I often say when I talk about this as an options market maker's easiest and most accessible tool to be able to change option valuation very quickly is turning the implied volatility dial either up or down. What it reflects is the volatility of the underlying price, the expectation of volatility going forward for the next N number of days. If you're looking at a 30-day option and you're looking at the implied volatility that's associated with the price of that 30-day option, what you're really looking at is, what does the market expect this underlying thing to move over the next 30 days? If it's a 10-day option, you're thinking, what is the market pricing in as an expectation for movement over the next 10 days, et cetera, et cetera. And it's really a consensus of all market participants. If you're in there trading options, if you're putting bids in, if you're putting offers in, if you're trading options at a certain price, you are creating implied volatility levels as well as price levels, which are going to be interpreted as implied volatility levels by more sophisticated players in the actual market. So who ultimately determines option market prices? Everyone. Everyone who's in there trading is actually a part of the process of price discovery and thus implied volatility discovery. It's kind of the market's most effective way to vote and figure out what the expectations are as far as a crowdsourced expectation for movement over the next N number of days. Everyone who is in there trading options is in there creating implied volatility levels that are commensurate with price levels. So I want you to think about implied volatility as a forward-looking metric, because that's really what it is. If you think about the price of the underlying over time, and you think about where we are today, what has happened previous to today, all the way up until today, is what we call historical volatility or delivered volatility. It is what has happened previously, and that is backward looking. Anytime you hear someone talk about implied volatility, most of the time they're also going to contrast that with historical volatility, which is the flip side of that coin.